We've got about 3 minutes left to trade. The Dow's down 172 points as we stand. I want to start, though, with the week picture. Firstly, the 10-year Treasury note for the week. You can see that significant lift up in yields that we've had. It happened earlier in the week. It happened again today. We crossed 3.2%, taking to the highest level since 2011. That has weighed on equity markets. Here's the S&P 500 for the week as a whole. It's only down about 0.5% today, but for the week as a whole, it is down 1%. And you can see in the last couple of days in particular, we've sold off as those rates have risen. What about the picture today itself? Here are the four indices. We're lower significantly on the Nasdaq, which has been the theme for the last couple of days. The Nasdaq's down a full percent. S&P and Dow down about 0.5%. That is well off the lows. The Dow, for example, was down 326 points at the lows. It's down 170 points at this stage. As for the sector performance today, only a couple of sectors holding on to some positive territory. In fact, only one holding on to positive territory, and it is utilities, up 1.6%. Everything else is in the red. Technology, once again, the laggard, as was pointed out by the Nasdaq, and communication services suffering as well. Bob Pisani joins me. The story of the day for you.
It's very simple. The jobs report is unlikely to change the pace of federal rate hikes. I don't think it's changed anyone's opinion. I think it was right down the line in the middle. Whenever you get a sudden move up, 16 basis points or so in the 10-year yield this week, that's a lot. That's a sudden move up. Normally, that would jolt the stock market, and it has. I think the correct interpretation is rates are rising for the right reason, given the combination that we're seeing here: record earnings, GDP at 3%, 50-year lows in unemployment, a remote possibility of recession in the next 6 to 8 months. I think the market can handle higher rates, and most people down on the floor, at least I've talked to today, are not that concerned about this move down today. Notice we cut it in half.
Yeah, we have. We've recovered towards the end of the session, as in fact we did yesterday with the selling. Let's have a look at quickly the sectors, the sector performance for the week as a whole. Only a few sectors positive. Interestingly, given it's been such a rate-driven week, financials and utilities are both higher on the week. You don't usually get that performance.
That is a little odd, but focus on the financials here. Yield curve has increased. We're probably 7 or 8 basis points increase in the spread between the 2 and the 10 years. Finally, remember we were talking, Wilf, you and I, 3 months ago about the fears of an inverted yield curve. Now the yield curve is steepening, and we have a different set of problems to worry about. Personally, I'd like to worry about a higher yield curve than an inverted yield curve.
Also worth pointing out, yes, the Nasdaq's down 2.8% for the week as a whole, which sounds bad, but we saw Hong Kong down 4.5%, we saw India down over 5%, Taiwan down 4.5%, China closed all week, may open with a bump on Monday early morning.